Hello and welcome to Switzer Investing. I'm Peter Switzer. Thanks for joining me. On tonight's program, we've got Paul Rickard looking at the stocks that he thinks looks really like good value right now. One in particular, I totally agree with him, and a sector that looks really good. Then we've got Adam Dawes from Shaw and Partners, and Adam's going to talk about the bottoming of the stock market and what he likes right now. And then Chris Joye will tell us why bond funds have done so badly, but why they might do well going forward. That's a very interesting discussion about bond funds. But before that, it's at times like this that I like to ask my readers, subscribers and clients and viewers, what kind of investor are you? And if you follow me and you are a short-term investor, I hope you know when to get out of stocks. I like because I don't rely on me to tell you things like that. I'm a long-term investor who buys good companies when the market beats up on really good quality companies. But when that's your strategy, you really have to be patient and not get rattled by all of the short-term oriented comments from market experts who want to play a much shorter game than yours truly. For people like me, you have to love the message of that famous legendary poet, Rudyard Kipling, who penned these words: if you can keep your head when all about you are losing theirs and blaming it on you, and if you can trust yourself when all men doubt you, but make allowance for their doubting too, and if you can wait and not be tired by waiting, or being lied about, don't deal in lies, or being hated, don't give way to hating, and yet don't look too good nor look too wise. To that I would add, yours is the earth and everything that's in it, and which is more, you'll be a great investor, my friend. And that's the important point. Don't be a short-term worrier when the market goes off the boil. If you've got a really good strategy, it will come back to serve you well. The key question many of you might be asking right now is, why is the US market crashing? See this chart of the S&P 500 versus the S&P ASX 200. What you can see there is that the US market really screamed out of the coronavirus crash, while our market didn't do much at all. So our pullback is really measured because we didn't grow too much out of the coronavirus crash. On a 7-year basis, the market's up about 30%. That's about 2% per annum. But at the same time, average dividend is about 4.5%. And with franking, you get about 6% in total over a long period of time. And over a 5-year period, the return was something more like 8%. But the interesting thing is, over the past 3 years with the coronavirus crash and all the other things, the market return has been minus 3%, minus 1% per annum. And that's why your portfolio is not doing all that well. But if the market actually rebounds, like Marko Kolonovic from JP Morgan has been suggesting, he sees a 27% gain towards the end of this year. That would push up your average return to something like 24% for 3 years or 8% per annum. You get my point? If you worry too much about the short term, you miss out on the long-term nature of stock markets, where the returns are a lot better than they are in the short term. Bottom line is, stop worrying about the market now. There will eventually be a nice comeback and you'll do well, provided you buy good quality companies that are being smashed up, beaten up by a market right now. Now, let's go to Paul Rickard and see what he likes right now. Well, at times like this, you're trying to look for value. What companies have been over smashed? And I like quality ones that have been over smashed. I think Paul Rickard does as well. So I've asked him to nominate a few companies that fit that category. Paul, good to see you.
Yeah, hi Peter. Look, I'm a bit like you. When the market is, look, it's we may not say it's in a bear market, but it's trading a bit like a bear market. Institutions are reluctant to commit new money, and everyone's still pretty nervous, and lots of talk about the big R word out there, and that's not going to go in the short term. So I'd rather stick for a couple of quality companies. I mean, there are a few out there that I think are showing reasonable, rounding type behaviour, and are trading okay. So there's rather than go for the stock that was $10 and is now 50 cents, and hoping that's going to rebound. I don't. That's a high risk strategy for me.
Yeah. So what's your first one?
Well, the first one's Macquarie Group, which I guess won't come as a surprise for some. But look, that's not super risky either. I mean, that stock was peaked at around about $220. early in the year, got down to about 160 in early June, and it really has bottomed since, Peter. It really has sort of sat between 160 and 170 through most of June, notwithstanding the market softening during that period. So it's actually
showed a bit of resistance, you think?
It showed quite a good degree of support. I think it got to about 156 or something. So it's actually about $10 higher than the bottom, which isn't bad given the market is not too far off its lows.
Yeah.
And I think the other reason why Macquarie, I like Macquarie, Peter, is it's got a great underlying business. That there are some pretty smart operators in Macquarie. It's got a good mix between its market-facing businesses, its trading activities, which are obviously market-dependent, but the market's fairly volatile, which is good. It's big infrastructure businesses, which is about finding cheap companies or cheap infrastructure assets and repackaging them, and also it's developing banking business, which has been a bit of a quiet area for Macquarie, but
they're really pumping it up now.
But they're pumping it up. So they're trying to get that mix between sort of what they describe as market-related income and annuity income sort of more even, and I think Macquarie's got value. So it's higher risk than the commercial banks. I think I should be clear about that. But it's come off, quite a bit, and it's showing to me good rounding signs.
And a lot of its money now is made in the US. So the fact that the US market is down over 20%, what was its worst, about 23, 24% down. It's not surprising to see that Macquarie is down. But if the predictions are right that the US market might rebound later in the year, that's going to be a good thing. It's a tailwind for Macquarie.
Yeah, there are a lot of opportunities for Macquarie, as you describe as tailwinds. I mean, it will, just to put the other side, it will get caught up. So if you're reading about, market uncertainty and US investment banks being hit hard, the chances are, as your Goldmans and your other listed Morgan Stanleys and your other listed US investment banks, the chances are some of that will flow through to Macquarie locally because it's competing with those investment banks. More than half of Macquarie's income now comes from offshore activity. So it's really big in a lot of very key markets. So it will get caught up in that. But look, they're good operators, and I think it's a stock to back. It's certainly if the economy recovers and activity picks up the other way, I'd say Macquarie's a big beneficiary.
Yeah, and I think that will actually happen. Let's go to another sector rather than the finance sector. Is there another sector you might like in some companies?
Look, I think healthcare's got a bit of value, and I was trying to think of. I think we're going to have a tough couple of months ahead, Peter, because. We'd all like to be buying tech, but I just don't think the market's got the confidence. We all know that tech's been really badly beaten off. And we've all watched in the last week or so as bond rates have fallen quite substantially in the US and in Australia. So some of the arguments about why tech stocks have been sold off so badly have sort of gone out the door because you've had a big rally in the bond market. But
and some good quality ones on the weekend did bounce back, like Atlassian was a bounce back.
You had a little bit of bounce back in the US, but it seems like the sentiment here in Australia, it ain't going to recover quickly. So I'm trying to think what might do better. Now, if interest rates, we'll get the Reserve Bank tomorrow. We'll get a lot of talk around, another increase in August. So I think the market's still going to be pricing more aggressive action by the central bank. I think the sector that could do okay in this sort of environment is healthcare, which although we have a lot of so-called growth healthcare companies, traditionally has been seen as a bit of a defensive sector. So we get caught up a little bit in when you read about you go to the US market and you see healthcare sector was up. The Americans think of it as a defensive sector, whereas we think of it more as probably a growth sector because most of our big healthcare companies are growing overseas, right? They're very product or market specific and they're leaders in their fields. Companies like CSL and ResMed and Cochlear, right? I think there's good value there, right? So they're all, again, stocks that aren't going down. And if anything, companies like ResMed and Cochlear have been creeping up. And as has CSL. So I think that it's almost...
All three you like? You give me
all three I like. I mean, CSL and ResMed probably the most. We're also coming into reporting seasons and some of those companies typically surprise on the upside, particularly CSL. Lower Australian dollars helping as well. Now, we've been bulls in the Aussie dollar, we've got that wrong, but the Aussie dollar at 68 cents is also helping companies like that because almost all their earnings come from offshore. Look, I think that's a sector that could do well over the next 2 months as people take a little bit of time before they really are committed or not committed to the R word, right?
And I think the point I'd like to make is that a lot of these calls we're making are not calls that we expect to make money in 1 month or 2 months, but by the end of the year, we expect to see the trend favouring these sorts of things. Similarly, the dollar. The Fin Review did a big analysis of what economists are predicting for Australia. It must mean at least 20 economists, and nearly all of them had the dollar going up over the next year or two and going into the mid-70s. So,
and they've sort of been half right, because the Aussie dollar has been really strong against every currency except the US dollar.
Yeah, that's right.
The thing is that the US dollar has been so strong.
Yeah.
And that's because of US interest rates. So when the rest of the world catches up, I mean, that's one of the reasons we still think there's upside in the Aussie dollar. So it's done well, it just hasn't done very well against the US dollar.
And also, if the recession calls are excessively bad, that would be good for the Aussie dollar. Every time there's a really terrible call on the dollar, commodity companies like BHP and other coal miners and whatever, get negatively affected.
Yeah, and lately the Aussie dollar's been hit by, the R word, slump in iron ore price, a little bit of slump in the copper price. Yeah. Coal and oil are holding up, but it's the others, and that's hurting the Australian dollar a little bit.
I also found it intriguing looking at the growth forecasts, and someone like Bill Evans has a 4% growth number for Australia. So I just think that. But all your selections today are companies that by Christmas time, people will be popping champagne saying, gee, Rickard's a smart bloke.
Let's hope so.
That's Paul Rickard of the Switzer Report. Well, joining me now is Adam Dawes of Shaw & Partners, and I've got him to talk about the bottoming process in particular, and also what stocks he likes right now. How are you, mate?
Really good, thanks, Peter. Yourself?
Very good, very good. Now listen, a lot of people, and I've been doing this over the last couple of weeks, is this market trying to bottom? Are we close to a bottom, or do you think there could be another big leg down?
Yeah, it's going to be interesting because we've obviously got RBA. Well, US is closed tonight. We've got RBA decision tomorrow, so potentially the market could have another sort of downward sort of turn if something comes a little bit unexpected with what's going on in the market at the moment. So I don't think we've seen the bottom. I think the market's definitely been trying to test it at that 6,400 level. Yeah. I think that's certainly something that we've got to be mindful of. But really, at the end of the day, I think that in that 6,400 might get tested tomorrow. But I do think that the potentially that it can go lower from here, and potentially have a 5 in front of it, and 5,800 somewhere around there might be close to where we could be going for a bottom. Yeah. But it'll all, it's all on people's philosophy and all on people, and I think the mood is fairly good out there, but it's just also a little bit nervous as well. Yeah,
I'm fascinated by the fact that we try. There's always buys at low levels. And we're going to talk about Magellan later, and I've noticed that every time Magellan gets to low 12s, there are buyers, and it kind of goes up to 13 or 14. And I'm sure those same people are selling it and making $2 on 12. But we'll get to that in a minute. But do you think reporting season is going to be critically important? And a lot of CEOs are going to have to come up with an outlook statement where they might say to us, well, we don't know, because we don't know if it's going to be a recession or not.
Yeah, I think that's absolutely correct. UBS put out a really good report the other day that talked about a correction in earnings of around about sort of 20%.
Gee.
Now, the PE, the price to earnings, the price has already come down. Okay. So there could be some earnings re-rating on some of the larger stocks at the moment because their earnings are still going to be impacted by COVID, weather, labour shortages, all of these kinds of things. So it will be interesting to see how the market reacts to those earnings downgrades, because I think the market's already reacted somewhat to a lot of that. So it's going to be quite interesting to see. But you're absolutely right. Companies are going to turn around and they're going to say, we don't know what's going to happen. We can't give you any forecasts. And the problem is the market will punish them on not being able to give some kind of outlook, which is going to be a little bit difficult.
Okay, let's go to Magellan, because a lot of people are asking me, and a lot of people, your clients are probably even asking you, what do you think's going on there? Yeah. And I threw out to someone the other day, and I said, well, look, in 2 or 3 years' time, I think we'd probably creep back to 20 from 12. $8 on 12 wouldn't be a bad return, considering where they were. And they've got a new CEO, haven't they, as well, or a new head of investment strategy. So what do you think about Magellan?
So look, I've been out there talking a lot about Magellan and really saying that I like the business and I like the company.
I didn't know that.
There's a couple of things that.
No, I didn't know you actually had. So it's interesting that you should say that. But go on.
Yeah. So I mean, down here, I think there's value. There's no doubt about that. I definitely think there's value down here. Can it go lower? Yes, it can. But one of the things is that I do like about it is that it's still got $65 billion of funds under management. Now, I mean, that's obviously a far cry from where it was. But it certainly does mean that there's still some fairly hefty fees that will be coming in. They have started to cut some of their staff and their workforce. And today was a classic example of shoot first, then ask later, because the whole funds management sector got belted a fair bit. Magellan was down 10%. Platinum Asset Management was down about 1.2%, and Pendle was down around 2% as well. So I think it's been that shoot first, but then ask questions later. But if you do hold it, I mean, obviously, if you didn't sell it at $54, $40, $30, $20, I mean, you'd still probably hold it. But the time I'm going to be selling Magellan or getting out of Magellan is when they reduce their fees. Now, they are one of the most expensive funds managers in the game at the moment, and they're obviously been cut fairly hard from ETF providers who are cutting their lunch a little bit there. And obviously, the series that is going to have to happen is that they're going to potentially, they'll lower their fees, or they just have to get some performance in the global fund. Once they get performance in the global fund, then more funds will arrive, and then the funds under management will start to move higher. So, is it a time to buy? Probably not. Is it a time to sell? Look, if you hold it, you probably stay with it. But it's the time to sell would be when you get a whiff of them selling or reducing their fees. That's exactly when there'd be the time to be selling this stock. So at the moment, they're still keeping their fees quite high, and at $68 billion of funds under management, that's pretty decent. It's going to definitely pay staff, and it should provide a decent dividend.
Yeah. And I guess the important point for these guys is a lot of advisors will probably be saying to their clients, we'll give them to the end of the year, and if they don't show any turnaround, well, then we'll find a different fund manager. I don't think advisors just jump out of a fund manager that's had a bad year, because until a year ago, it was one of the better performing fund managers. So I must admit that would be my attitude toward it as an advisor myself.
Yeah, you're right. They don't move quickly, and they want to see some evidence of a turnaround. So that evidence would definitely be funds under management moving in the right direction, or performance starting. I mean, they were very heavily in cash before, while the market was running hot. I think they've moved now a lot out of that cash, and they've invested a lot of money. So hopefully that will then start to bring forward some of those numbers for the global fund at least. But they've got a fantastic infrastructure fund. They've got some other funds in there that are actually quite good. But everything obviously hinges on that global fund. That's probably where the lion's share of the funds under management is.
And I don't think Hamish Douglass would be sending President Xi any Christmas cards for what he did to some of the Chinese investments he had in his fund as well.
Well, I don't think Hamish Douglass will be on many people's Christmas cards.
No, I mean sending cards I'm talking about.
Yes,
but you're
sending.
Right.
You're right.
All right, okay, let's go to, let's not talk about Christmas. It's too early for Christmas. Though I've got to say, the market will be better at Christmas. I'm looking forward to Christmas. Any stocks that you like? You've said you've been talking about them. I did say in my note to you, are there any stocks in particular you think just look like fantastic value?
Yeah, look, obviously there's been a lot that have been hit pretty hard. What I do like, there's a couple of Aristocrat, had an earnings upgrade the other day. That one's off, 40, 30%. Aristocrat looks really good down here. And if you've got a 1 to 2 year time horizon, that's a perfect one for you. James Hardie's another one that is a fantastic business. That got hit really, really hard as well. I think there's definitely some value in there. Today it's started to get a little bit of a wriggle on as well. The other one I like is ResMed. So there's three there in very different sectors, but ResMed in that healthcare space is also looking good. I've got two other stocks that if you're willing to hold on for a little bit longer, is probably potentially some takeover targets. APA, I think with the infrastructure there's no infrastructure stocks on our market anymore. APA is definitely one of those ones that I think is fairly ripe for a takeover. And then there's been a little bit of scuttlebutt around the market around TLC, the Lottery Corporation, is going to be a potential takeover target as well. And we just saw Mr. Cook leave the company to join Tyro. Your favourite company.
Yes, right. He left Tyro. Former favourite.
He left Tyro and he's former favourite, He left Tyro and he's gone over to Star Casino. Yeah. Now he was instrumental in the merger of Tabcorp and Tats in the heyday back when things were good. Yeah. So I think that's why Star potentially might have a look at the Lottery Corporation. But these is no advice, everybody. These are very speculative investments, and please seek professional advice before you do anything.
Without a doubt. Adam Dawes, thanks for joining us.
Thanks. Have a great evening.
Same to you, mate. That's Adam Dawes of Shaw and Partners. Now let's go to the bond funds, Chris, because you run a bond fund business, and I know one of my financial planning clients said that you wrote something about floating rate bond funds. You expect them to do well. Now, I was interested because you run the Switzer High Yield Fund, which is a floating rate bond fund. Why are you saying that they should do well going forward?
Well, floating rate bonds have massively outperformed fixed rate bonds over the last year. So I don't have the exact numbers in my head, but roughly speaking, the fixed rate bond index is down, I believe, peak to trough, about 15%, which is a very, very significant loss. This is an Aussie fixed rate bond index. It's AA rated, ostensibly very safe, very defensive, and it's down 15%. It's probably performed pretty similarly to equities and hasn't necessarily offered the protection that people might have expected from fixed rate bonds. The floating rate note index, so there are two types of bonds. There's a fixed rate bond where the interest rate is fixed in the same way that you might fix an investment rate by allocating to a term deposit. So you could buy a 5-year term deposit and maybe you fix it 3% or 4%, whatever the interest rate is on a 5-year TD. Alternatively, you can invest in a floating rate or variable rate deposit where the interest rate will just go up and down with the RBA cash rate. And the same principle applies to fixed rate bonds and floating rate bonds. So in a floating rate bond, that bond will pay you an interest rate at a margin above the RBA cash rate. And as that cash rate increases, the interest rate on the bond will rise. With a fixed rate bond, on the other hand, as interest rates increase, the price of the bond falls because you fixed the coupon payment, and the price has to adjust to make new buys of that bond indifferent between that bond and, say, a floating rate product. So what we've seen is that the floating rate universe has probably lost between 1% and 3% over the last year. So floating rate notes or floating rate bonds in Australia that are also AA rated have fallen in value between 1 and 3 percentage points, which is a record decline in fixed income values. Certainly that floating rate note index has recorded many months of negative returns. I think there have been 2 periods since January 21. So since January last year, that index has had 3 negative months in a row twice, and that had never happened before. And then in the case of the fixed rate bond index, it's technically called the composite bond index. That index, as I mentioned, peak to trough is probably down 14 to 16%. And that index performance is the worst in 33 years, the worst in recorded history. But crucially, the reason floating rate notes have outperformed fixed rate bonds is because as interest rates have lifted, rather than adjusting in price, they've adjusted through the higher cash rate, and they've got the benefit of that. Unfortunately, that's not the entire story. So as I mentioned, a floating rate note pays a margin above the cash rate. High cash rates benefit floating rate notes. High cash rates hurt fixed rate bonds. That margin has also expanded. It's called a credit spread. And we've seen an increase in credit spreads in Australia and overseas of something in the order of 75 to 150 basis points. What that means is that margin has increased by 0.75 percentage points to 1.5 percentage points. So holders of floating rate notes have benefited from the RBA cash rate going up, but they have been hurt by wider credit spreads. The quid pro quo for both those indices is that right now we're sitting on much, much higher yields than we were 12 months ago. So 1 to 2 years ago, these indices were paying 0.5% in yield. Today, they're paying 3 or 4%, if not more. And you can take a simple example, which would be a bank hybrid. And we've seen, if we take a CBA hybrid security listed on the ASX, those hybrids were paying about 2% over the RBA cash rate. Now, in markets, we don't really talk about the RBA cash rate as much as, or in the bond market, we talk about, there's a proxy for the RBA cash rate, and it's called the bank bill rate, or technically something called the bank bill swap rate. But it's a 3-month interest rate. So we talk about what margin does a bond, or what interest does a bond pay above the 3-month bank bill swap rate. Now, the 3-month bank bill swap rate last year was about 0.01%, basically zero. So if a hybrid was paying you 2% above 3-month bank bills, you were earning about 2% interest on that 5-year CBA hybrid. But today, that hybrid is paying you about 3.6% above bank bills, right? And then the bank bill rate has jumped from 0.01% to about 1.8%. So what that means is last year on a CBA hybrid, you're earning 2%. This year, you're earning 5.4%, right? And that's obviously a big deal. And so you've got a huge improvement in yield. And indeed, we've got the best yields now in bond markets than we've had in a very, very long time. You can get almost a 4% interest rate on a 10-year AAA rated Aussie government bond, which is basically riskless if you hold it to maturity. Alternatively, you can get 3 to 4% term deposit rates for 12 months. And the yield to maturity on our portfolios, so if I just check that product you mentioned before, the yield to maturity right now is about 4.5%. So these are very, very attractive yields. But the quid pro quo, or the trade-off for the attractive yield, is the fact that you've had to suffer some capital losses or some negative returns recently as the price of the bonds, be they floating rate notes or fixed rate bonds, have adjusted to the higher RBA cash rates and the wider credit spreads.
Yeah, because when yields go up, prices go down.
On a fixed rate bond, on a floating rate bond, when yields go up, the floating rate bond price does not go down. If the yield, but when we talk about the yield, if we're talking about if the cash rate goes up, the floating rate note will just pay you higher interest and the price of the note will not adjust. If the credit spread, or that margin above the cash rate that it also pays you, if that widens, then yes, the price will go down. And what we've seen is cash rates rise. So when we talk about cash rates, we mean normally the overnight RBA cash rate. We've seen 10-year risk-free rates or government bond yields jump dramatically. So in Australia last year, the 10-year Commonwealth government bond paid you an interest rate of about 1.something%. This year, it's paid you as much as 4.2%. So you've literally seen the yield or the interest rate on a Commonwealth bond almost quadruple. And that's tough if you've been holding that Commonwealth government bond for 12 months because you've suffered a big capital loss. But the benefit or the silver lining is looking forward, you get much more attractive returns.
Okay, the summary is when people ask me about Switzer high yield funds, say, we lost a lot less than most other bond funds, and this year it's looking good.
Well, obviously, we can't give forward-looking return expectations, but what we would say is that floating rate notes, which that product is a floating rate product, have massively outperformed the broader bond benchmarks, both in Australia and in the US or globally, and specifically the fixed rate bond universe. And the average interest rate in the portfolio today, or the average yield to maturity, there's different measures of yield, but the yields or the interest rates we're earning today are the highest they've been in years. And all things being equal, that should mean higher returns in the future. Okay. But that's subject to the risks.
So whereabouts is the yield now on Switzer high yield fund?
So the yield to maturity on the Switzer high yield fund is about 4.5%.
Okay.
but we do, people need to read the product disclosure statement. They need to understand
Of
the
course,
risks of these products, and they also need to speak to, or they should speak to advisors if they can avail themselves of an advisor for personal advice.
Yeah, without a doubt.
Can I just make one other point, mate?
Yeah, but
one other point I just want to make.
Will other bond funds do better this year? Will the fixed ones have been clobbered because interest rates have taken off, but will the bond fund managers in the fixed rate bond funds, will they have a better year, do you think, going forward?
I think so, yeah. I definitely think there's a good chance that the guys that have been clobbered are the fixed rate bond funds, the composite bond managers. So that index, as I mentioned, is down probably 14+%. In the US, the bond benchmark is down, I think, 16 to 20%. Yes, US equities have fallen 20 to 30%, so bonds have slightly outperformed, but nothing like many people would have assumed or hoped. But what I will say, buddy, is think about this. NAB's equity, on a grossed up basis for franking, that pays you about 7.5%, if I'm not mistaken.
Yeah.
Right. The yield to maturity on an NAB hybrid is also about 7-8%. So the hybrids sit one notch up the capital structure. So you've got equity, they're the first loss piece, then hybrids, then subordinated debt, then senior bonds, then covered bonds, and then bank deposits. Or actually, sorry, bank deposits actually sit below covered bonds because bank deposits are unsecured and the covered bonds are secured. But my simple point is there are some incredibly attractive interest rates that you can avail yourself of in fixed income markets, be it on senior bonds, subordinated bonds, government bonds, or hybrids. And I actually think, I actually think this poses a bit of an existential challenge for equities, mate, because if NAB's dividend yield, including franking 7.5%, and you can get the same return on the NAB hybrid, then why would you buy the equity? Or let me put it differently. If the All Ordinaries Index, which I'll just bring up in front of me right now, is paying a franked dividend yield of, I'm guessing, about 5%. Let me just check. So. Yeah, so they're franked.
Yep.
Yeah, so right. Oh, actually, it's actually, according to this, the All Ordinaries Index is paying a franked dividend yield of 6.7%. But again, we can buy a 5-year CBA Tier 2 subordinated bond, which is paying a fixed rate of interest of 6%. So what, which is BBB plus rated. So would you, is a dividend yield of 6.7% attractive enough on Aussie stocks with all their risks of 20, 30, 40, 50% capital losses when you could buy a CBA fixed rate bond that's paying you 6% per annum for 5 years? What I'm suggesting, Peter, as an idea for people to think about is potentially we still need to see some revaluations across all asset classes. Another good example that's actually particularly pertinent to your viewers is residential property. So think about the gross pre-fees yield you get on an investment property. You're probably looking at 3-4%. So why would you want to get, before all the transaction costs and depreciation that you suffer with an investment property, why would you want to get a yield of only 3 to 4% when you can get a term deposit for 3%, or you can get a CBA bond paying 6% fixed for 5 years? It kind of doesn't make sense. Or think about commercial property. Some commercial properties pay yields of only 3.5%, 4.5%. Again, these are risky assets that fluctuate wildly in value if you try to sell them. So I think that there's an existential portfolio construction challenge that people need to think about, because if these interest rates remain high for a significant period of time, which I think is the risk, then the value of a lot of asset classes will continue to adjust. And we expected these interest rate increases late last year. So that's why in December in the AFR, I said in my column that I thought US equities would fall at least 30%. I thought cryptocurrencies would get absolutely smashed. Bitcoin is off 71%. We thought duration, that's a technical term, we thought fixed rate bonds would get hammered. We thought floating rate notes would also get hammered because of wider credit spreads. We were negative on our own asset class. And that's what we've seen come to pass. But I think the good news in bonds, at least, is the interest rates that are on offer in the bond market, they seem to be pretty attractive. And I think, to answer your question, there's a case that even fixed rate bonds now will start to perform. For them to perform, we will need to see the whites of the eyes of the interest rate cycle. So we'll need to know that markets are fully pricing in the peak in interest rates. Yep. And my sense is there is a very good chance today that the interest rate hikes that markets are pricing are either about right or they're too much.
Yep.
And if they prove to be too much, what that will mean is that rates or yields in markets will fall and bond prices will rise.
And the fund managers who got in recently at high rates could look really smart, and their funds will do well. Mate, thanks very much for your tips, and a lot of the things that you said about the markets, about equities, you said on this program, and you have been proved to be right. And it's the only reason why I listen to you. Being right's a good reason to listen to you.
Well, one thing I'll say about you, Peter, is you're a lovely human being. We've known each other for years. You're a great guy, but you're also incredibly smart. I'm sure most of your viewers know this, but Peter was basically a academic economist approximately 113 years ago. So he looks a lot younger than he is. But you're the best in the business in terms of what you do, and it's a real privilege to have time to talk to you.
Cheers, mate. Thanks for joining us.
See you, buddy.
And that's the show for tonight. We'll see you on Thursday. Chris Joye has another interesting take on house prices. He doesn't think house prices will fall 30%. How much does he think? Find out on Thursday. Thanks for joining us, and go to switzerreport.com.au.